this is going to be one of the most important lessons you'll be learning. And because why? You'll be using this very frequently, as I have always been using this almost daily in my chart scanning. I will look for this kind of candles before I make some decisions. And of course, this is when we talk about bullish pin bars or hammer, it's definitely represented by these pictures right here. This gray color here is pin bar, and of course you see a hammer, and they belong to powerful bullish candlesticks. And of course, let's go back to this chart again. And what we have covered previously was the bullish ice cream, and today this is where we are going to cover, because all these four different variants are actually the same category. They are known as bullish pin bars. Alright, so we'll cover this in the next topic. So today we are going to focus in these four pin bars. Right, so you're going to have fun on this one. Okay, so now how does it look like and how we define these candlesticks? So the first thing is that the colors does not matter. Whether it's red or green, white or black, it doesn't really matter. So what matters is the size of the shadow. So the size of the shadow is about 2/3 or slightly more than the entire candle range. So that means it could be 66% or more, this part of the candlestick. Alright, so of course this is on the fat hammer, and then you have skinny hammer, you have mining pig, and bullish cross. And even some of the traders, they call the bullish cross crucifix also as well. And of course, a bullish hammer is referring to, the fat hammer is referring to this. Skinny hammer, this one, mining pig, because it really looks like a mining pig, right? And of course, you have bullish cross right here. So they all look very similar right here. Of course, and generally most people call this bullish pin bar, alright? And what are the shapes and sizes? We have covered bullish ice cream bar earlier, and let's go to the fat hammer. And this is where we mentioned just now it was supposed to be about 66% or longer lower shadow, right, of the entire candle range. And if it's a skinny hammer, it could be around 80% or longer of the entire range of the candle right here. And if it is a bullish cross, you might find it around 66% or longer on the lower shadow part. Right, so now how does it form? So this is how it forms. And let's say the day, in the day starts, then it opens at this area. So immediately we see a huge rejection. The bears are coming in, and up to a point that it could not bring the price lower, and this is where the bears starts to come in also as well. A lot of bears starts to come in, and then you have a huge rejection on the price, and the price goes up very sharply until it goes up even higher than the opening price and closes above. So that means the bulls are in control, and it's very committed to close the price at the high or higher than the open. So of course, it's not just green color. What we saw was just green color, slightly green color body. And sometimes these pin bars or hammers can come in red color. And of course, the price, opening price is very high right here. And it gets rejected all the way downwards. And it couldn't go any more lower. And then you have a lot of rejection here from the bulls, bringing the price all the way upwards. So as long as it brings the price upwards about more than 66%, sorry, 66% or more, then it's still considered there's a huge bullish sentiment, which actually there's a lot of bulls, people who buy a lot here, rejecting the price from going downwards. Right, so there's a V shape again right here. Typically, you will see a V shape or chart pattern within a daily chart pattern. All right. So of course, this one, the close is slightly lower than the opening price. So now let's look at the real example here, and we may have many candles in a single chart, in a single day session, and this is how the sentiment looks like. Now this is the beginning or opening of the price, and here we see there's no body form at that moment, but in the first half an hour of the session, we see bulls are trying to come in, and they get rejected a lot of this area. All right, so that's the high in the entire session right now. All right, that's the high. And once it gets rejected, it goes all the way downwards here and forming like a bearish ice cream bar. So it forms a bearish candle, very long bearish candle body. And again, here it couldn't make any lows anymore. So the bulls, they start to rush in almost at the last hour of the session, bringing the price all the way upwards higher than the opening price. And this is where the close and the highs are very near. So it doesn't actually matter quite a lot here. When you have small upper shadow, it doesn't matter, because most of the time here, in this area here is where it matters the most, because the bulls are committed to bring the price upwards, rejecting the bears very strongly from this area onwards. And this is where very sharp candles going upwards. Right, so let's look at another example right here. And this is quite straightforward, because this is the opening price and it is considered the highest price of the day. And this is actually, the closing is slightly lower. And we can see here, okay, let's, the price opening, then the candle starts forming. And then immediately there was a huge rejection, and you know, almost half of the day has gone by. And there's a lot of bullish players coming into this part here, and rejecting a lot of bearish players. And then when price goes up, as the bearish players comes in and try to bring it down lower, but the bulls are they keep pushing the price upwards, and until it ends very sharply upwards at this point. So of course we can see a huge jump on the price, where it manages to close on the very close to the high and open. So the bulls, because of the rejection, a huge rejection of a price going lower, and a very strong bounce, then the bulls are in control for the last half of the session. Alright, so where you may find these candles, and these candles, very often you find these candles at the very low part of the chart. Like in this area, this is a very important demand zone. You may find huge bullish pin bar candles there. And of course, sometimes you might find some over here. There's this like a previous resistance becomes a support. So bam, right? Then that goes all the way up. Okay. So, and like we said earlier, you can find these candlesticks in areas that are very low. And we can say this is actually a demand area, because price has actually visited this area, and there was some panic selling, and immediately there was a lot of demand coming into this zone right here. And of course it forms a bullish pin bar, and I forgot to mark this one also as well, because that is also very important, the level. Then it comes back, retests these levels, and it keeps going up. Right, of course I didn't put the entire time frame in this one, but the price rallied after that. More examples. Okay, this is also okay, one of the example that the price, I mean this pattern, candlesticks pattern, form at a very low part of the chart. And you may also see one here. This is quite small, right? Quite small, but you can see that it's trying to bring the price even further upwards. And this is quite a huge demand zone. As it goes down to this part, then gets rejected, then goes up strongly. Right. Okay, and this price, they tend to bounce off. I mean, these kind of candles can be seen bouncing off a dynamic support, moving averages. The red color line is a dynamic moving support. And if that is actually, sometimes it's important, then the price will respect those levels, and they find support in those levels. before they rally even higher at those points. So this is a very important dynamic support, and we'll cover in the next few chapters that part. Okay, right. So, and this is Google. It's quite interesting, and as the price is actually, this is a panic selling right here. As there were many sellers coming through because this stock is strong in fundamentals, and there were a lot of buyers coming in. They're trying to bring the price upwards. So you may see multiple pin bars in this chart until it reaches a point where this is like the maximum. You can see a lot of bullish pin bars form as the price keeps going down. So there's a lot of buyers, lots of rejection from the buyers to reject the bears from going lower. And even as it travels upwards, then it keeps forming more bullish pin bars right here. All right. So okay, more examples. You can always find this at the low part of the charts here. 4 examples right here. Yes, and yep, and you can find them also in very important convergence, or what they call it. Yeah, confluence trading means that you combine several different levels. This is like a resistance, and if you combine it with a dynamic support, which is called moving averages again, and if those 2 points come together, they confluence or they converge together, and that becomes a very strong rejection point, right? Rejecting the price from becoming lower, and that brings the price to rally onwards, right? So again, you will see before even price breaks out, it forms a huge bullish, I mean a nice bullish pin bar, and after that you can see the price breaks upwards and rally. So more examples right here, and this is a cross, bullish cross, and this is just right after a panic selling, and actually it forms right under these levels, this important demand zone, and there's some confluence on that part. It actually hits the green color moving average and closes above again, comes down, forms another one. Right here, there was another this bullish cross right here, and it comes back to this important zone, then it goes up, rallies all the way. All right, this is also a very strong fundamental stock. So okay, that's the end of the presentation, and I'd like to thank you for your time. Happy trading and investing. Striker X here, signing out.